The dollar is holding gains right now, and that fact alone tells you almost nothing about where the dollar is actually going, because the conditions under which those gains are being held are so artificial, so disconnected from normal market functioning, that treating this week's price action as meaningful would be one of the most dangerous mistakes you could make with your money. Let me show you exactly what is happening in currency markets right now, because the surface calm is hiding something that will become violently apparent the moment real trading resumes. Trading volume this week is at its lowest levels of the year. Markets across Asia are closed for the Lunar New Year holiday. Singapore, Hong Kong, China, Taiwan, all dark. The United States just came off President's Day on Monday. London is the only major financial center operating at full capacity, and even there, desks are thin because everyone knows the real action comes later in the week when the Federal Reserve releases its January meeting minutes and when advanced GDP figures hit. In that vacuum, the dollar index inched up to 97.12. It gained 0.2% in the previous session. The euro slid 0.1%. Sterling weakened 0.11%. The yen moved 0.3%. These are tiny moves in a market that normally sees billions of dollars change hands every hour. And the reason the moves are tiny is not because the dollar has found equilibrium. It is because there is almost nobody trading. When volume is this low, price action becomes meaningless noise. A single large institutional order can move the market more than a day's worth of normal trading. And the institutions that would normally be pushing back, the Asian central banks, the sovereign wealth funds, the hedge funds with macro positions, they are either closed or running skeleton crews. The dollar is not holding gains because the market believes in the dollar. The dollar is holding gains because the market is not really open. This matters because in approximately 72 hours, that changes. On Wednesday, the Federal Reserve releases the minutes from its January meeting. Those minutes will show exactly how divided the committee is. They will reveal whether the hawks are gaining ground or losing it. They will show whether the doves are pushing for cuts despite inflation running at 3%. They will signal whether Kevin Warsh's nomination is already changing the internal dynamics. And later in the week, advanced GDP figures will show whether the economy is growing fast enough to justify holding rates or whether weakness is building that will force the Fed's hand. These are not minor data points. These are binary events that could trigger violent repositioning in a market that has been sitting still for days. And when markets sit still and then move, the moves are always larger than expected because all the orders that would have been executed gradually over multiple sessions instead hit at once. Christina Clifton, senior currency strategist at Commonwealth Bank of Australia, said something this week that captures the entire precariousness of the dollar's position. She said the most important driver of the dollar through 2026 will be the narrative of U.S. exceptionalism, not U.S. exceptionalism itself, the narrative of it. That single word, narrative, tells you everything. Because a narrative is a story. A narrative is something that can be believed or disbelieved. A narrative can hold for years and then collapse in a single week when the evidence against it becomes overwhelming. The dollar's value right now is not based on superior economic fundamentals. American GDP growth is adequate but not exceptional. Inflation is running at 3%, higher than the Eurozone, higher than Japan. The labor market is stable at 4.3% unemployment, but not dramatically stronger than other developed economies. The fiscal situation is deteriorating with $36 trillion in debt and $2 trillion annual deficits. By the traditional metrics that determine currency value, the dollar should not be trading where it is. What supports the dollar is the belief that America is different. The belief that American innovation will drive growth that other countries cannot match. The belief that the Federal Reserve will eventually do the right thing, even under political pressure. The belief that American institutions will hold even when tested. The belief that the dollar's reserve currency status is so entrenched that it cannot be challenged. That collection of beliefs is the narrative of U.S. exceptionalism. And Clifton is telling her clients that the entire trajectory of the dollar in 2026 depends on whether that narrative holds. Let me show you the evidence that the narrative is cracking because the data from the past year is unambiguous. In 2025, the United States dollar suffered its largest annual drop in 8 years. The dollar index fell 9% over the course of the year. That decline erased years of accumulated strength. And here is what makes it significant. The decline happened despite the United States having higher interest rates than most developed nations. It happened despite the U.S. being the world's largest economy. It happened despite the dollar being the global reserve currency that everyone supposedly needs to hold. When a currency declines despite having all the traditional factors that should support it, something structural has changed. The narrative is being questioned. The beliefs that underpinned dollar strength are being tested, and the testing accelerated dramatically on one specific date. In April 2025, President Trump announced Liberation Day tariffs, sweeping import taxes on nearly every major trading partner of the United States. The dollar fell more than 5% in the days immediately following that announcement. That was the market's instant verdict on what the tariffs meant for America's role in the global economy. Not strength, weakness, not stability, chaos, not reliability, uncertainty. And here is what should alarm you. Nearly a year later, the dollar has not recovered those losses, despite multiple rallies, despite periods of apparent strength, despite thin trading weeks like this one where the dollar drifts higher because nobody is there to sell. The market repriced the dollar permanently lower after Liberation Day, and nothing that has happened since has changed that repricing. Goldman Sachs addressed this directly in a recent client note. Their foreign exchange strategist wrote that fundamentally, we think the recent injection of policy uncertainty will be sufficiently durable to keep the dollar from making up lost ground. Investors came into the year expecting more support for the economic cycle, but instead a series of new tariff threats have shaken those expectations. Goldman Sachs is telling its institutional clients that the dollar will not recover. Not that it might not recover, that it will not. Because policy uncertainty is durable, meaning it persists, meaning it has become a permanent feature of the American economic landscape rather than a temporary aberration. And when the world's most influential investment bank tells trillion-dollar clients that the dollar cannot make up lost ground, those clients reposition accordingly. They reduce dollar exposure, they increase exposure to alternatives. And their repositioning reinforces the very weakness Goldman Sachs is describing. Now let me show you what real money investors are actually doing, because this is where the narrative meets reality. Bart Wakabayashi, the Tokyo branch manager at State Street, one of the largest custody banks in the world managing trillions in assets, said something this week that reveals the quiet repositioning happening beneath the surface. He said investments continue to come into Japan, and it is looking good. Real money investors have been reducing their overweight in dollar-yen, so buying the yen and selling the dollar. Let me unpack that because the implications are enormous. Real money investors is a term that refers to the largest, most stable pools of capital in the world. Pension funds that manage retirement savings for millions of workers. Sovereign wealth funds that invest the national savings of entire countries. Insurance companies that hold reserves to pay future claims. These are not hedge funds making speculative bets that reverse in days. These are institutions making strategic allocations that persist for years or decades. When State Street says real money investors are reducing their overweight in dollar-yen, they are describing a structural shift in how the largest capital pools in the world view the dollar. These institutions were overweight dollar-yen, meaning they held more dollars relative to yen than their benchmark allocation called for. They held that overweight because they believed the dollar would outperform the yen. Now they are reducing that overweight, buying yen, selling dollars, and they are doing it not because of any single data point, but because their long-term view has changed. This is happening despite the fact that Japan's economy barely grew last quarter. Official figures released Monday showed Japanese GDP essentially flat. That data stalled a recent yen rally. Under normal circumstances, weak economic data would make a currency less attractive. Investors would sell the currency of a stagnant economy. But real money investors are buying yen anyway. They are selling dollars to buy the currency of an economy that barely grew. That tells you something profound about their view of the dollar. They would rather hold yen, backed by a stagnant economy, than dollars, backed by the world's largest economy. Why? Because the Bank of Japan is raising rates while the Federal Reserve is expected to cut. Because Japan offers policy stability while the United States offers tariff chaos. Because the narrative of Japanese stability, however imperfect, is more credible right now than the narrative of American exceptionalism. And Japan is not the only beneficiary of the dollar exodus. Gold appreciated by more than 60% through 2025. 60% in a single year for an asset that pays no interest and generates no cash flow. That rally is one of the strongest on record. And gold is still up more than 70% over the past year despite recent pullbacks. Silver surged, platinum surged, copper surged, steel surged. Every hard asset, every physical commodity that cannot be printed by a central bank or devalued by a government policy decision became dramatically more valuable relative to dollars. Ole Sloth Hansen, head of commodities at Saxo Bank, wrote that a key accelerant behind the renewed demand for hard assets has been the US dollar. Concerns around U.S. stability and a growing outflow of capital into other markets are adding to an already fragile backdrop for the currency. He is identifying a feedback loop. Dollar weakness drives demand for hard assets. Demand for hard assets means selling dollars to buy those assets. Selling dollars weakens the dollar further, which drives more demand for hard assets. The cycle reinforces itself. Other currencies are benefiting too. The euro has rallied against the dollar. The British pound has rallied. The Swiss franc, historically a safe haven alternative to the dollar, has rallied. And here's what makes the current environment particularly unusual. Emerging market currencies are rallying against the dollar. The Brazilian real, the Mexican peso, the South African rand. These are currencies that historically trade at steep discounts to the dollar because emerging markets are seen as riskier, more volatile, more prone to inflation and political instability. When emerging market currencies outperform the dollar, it means investors believe those currencies, with all their risks, are preferable to holding the world's reserve currency. Bank of America addressed this directly in a recent note. They said it is likely too early to call the movements in foreign exchange pairings as signs of dollar debasement. In a true debasement scenario, they argued, you would see the dollar in a prolonged drawdown alongside falling valuations in other U.S.-based financial assets. But they acknowledged that recent moves show nascent signs of differing from cyclical currency swings and suggest larger structural changes in investor preferences. And they concluded that the dollar may have more room to fall as the fundamental drivers of dollar weakness, such as a dovish pivot from the Fed, and the lagging impact of trade wars with Europe and China, have yet to play out. Bank of America is describing the early stages of exactly what bears fear. Nascent signs of structural change, investor preferences shifting away from dollar assets, fundamental drivers of weakness that have not yet fully materialized. They are not calling it a crisis yet, but they are describing all the elements that precede a crisis, and they are warning that those elements will intensify, not fade. Now let me show you the political dimension, because this is where the narrative of U.S. exceptionalism collides with the reality of how American policy is actually being made. The White House says it wants a strong dollar. That has been the official position of every administration for decades. A strong dollar is supposed to be in America's interest because it keeps import prices low, attracts foreign investment, and signals confidence in the American economy. But actions speak louder than words, and the actions of this administration directly undermine dollar strength at every turn. President Trump, in comments to NBC News on February 4th, said he would not have nominated Kevin Warsh to be Federal Reserve Chair if Warsh had expressed any interest in raising rates. Let me quote that directly. If he came in and said, "I want to raise them," he would not have gotten the job. The president said there is not much doubt the Fed would lower rates because we are way high in interest. That statement destroys the independence of the Federal Reserve in 2 sentences. The president publicly confirmed that monetary policy decisions that are supposed to be made by an independent central bank based on economic data, are instead being made based on the president's personal preferences. He selected a Fed chair nominee specifically because that nominee would cut rates. He publicly stated that anyone who wanted to raise rates would have been disqualified. He expressed certainty that rates will be lowered regardless of what the data says. Lower interest rates weaken the currency. This is basic economics. When a central bank cuts rates, the return on holding that currency's assets decreases. Capital flows to currencies with higher returns. The currency being cut depreciates. A president who demands rate cuts is demanding a weaker dollar, regardless of what the official White House position claims. Thierry Wisman, global foreign exchange and rate strategist at Macquarie Bank, said something this week that every American needs to understand. If the reserve status of the dollar does depend on the U.S. role in the world as guarantor of security and a rules-based order, then the events of the past year carry the seeds of a reallocation away from the dollar and the search for alternatives. He is saying the dollar's reserve currency status was never based purely on economic size. It was based on trust. Trust that America would uphold international agreements. Trust that American institutions would function predictably. Trust that the Federal Reserve would prioritize price stability over political convenience. Trust that the rules-based order America built after World War II would be maintained by the country that built it. The events of the past year have damaged that trust. Tariffs imposed by emergency declaration, trade agreements abandoned, allies treated as adversaries, the central bank openly pressured to deliver politically convenient rate cuts, the rules-based order questioned by the very country that guaranteed it. Every one of these events chips away at the trust that made the dollar valuable. And trust, once lost, takes generations to rebuild. Wisman went further. He said, "We do not think that over the medium and long term, the dollar diversification trade is over. Weak dollar waves, usually prompted by important geopolitical shifts and policy uncertainty in the U.S., can last for a decade or longer. Under the direction in which the U.S. administration seems to want to take the U.S. vis-a-vis the rest of the world, the dollar cannot maintain its reserve currency status indefinitely." A decade or longer. That is not a cyclical pullback. That is a generational shift in the structure of global finance. And it is being driven not by external forces attacking the dollar, but by American policy choices that undermine the dollar from within. Stephen Kamen, previously the head of international finance at the Federal Reserve, wrote in a recent column for the Financial Times that at present, there are no good alternatives to the dollar for a global currency, not even the euro or renminbi. The U.S. still has the world's deepest and most liquid open capital markets. But whereas a few years back one would have been hard-pressed to foresee a world without dollar dominance, now one can readily imagine such a disorder emerging in the coming decades. A former senior Federal Reserve official is saying the unthinkable is now imaginable. Not likely, necessarily, but imaginable, within the range of plausible outcomes that serious people are considering. That is how far the narrative of U.S. exceptionalism has fallen, not to the point where collapse is imminent, but to the point where collapse is conceivable. And when collapse becomes conceivable, prudent investors begin repositioning. They reduce exposure to the asset that might collapse. They increase exposure to alternatives, and their repositioning, aggregated across trillions of dollars in global capital, makes the collapse they fear more likely. Now let me show you what happens in the next 72 hours, because the data releases coming this week are not ordinary economic reports. They are catalysts that could either reinforce the narrative holding the dollar together or accelerate its unraveling. On Wednesday, the Federal Reserve releases the minutes from its January meeting. We already know from the official statement that the committee voted 10-2 to hold rates steady at 3.5 to 3.75%. Two governors, Stephen Moran and Christopher Waller, voted to cut. But the minutes will reveal the full discussion. They will show how many officials supported signaling that the next move could be a rate hike rather than a cut. They will show whether concerns about inflation at 3% are intensifying or fading. They will show whether Kevin Warsh's nomination is already influencing the committee's deliberations. If the minutes show a Fed that is leaning dovish, that is more worried about economic weakness than inflation, that is preparing to deliver the cuts the president demands, the dollar will weaken. Markets will price in faster, deeper cuts. The interest rate differential between the United States and other countries will narrow. Capital will flow out of dollar assets. If the minutes show a Fed that is divided with significant support for rate hikes, the dollar might stabilize temporarily. But division itself is not dollar positive. A divided Fed is a paralyzed Fed, and a paralyzed Fed cannot respond coherently to the challenges facing the economy. Markets do not reward paralysis with confidence. Later in the week, advanced GDP figures will show how the economy performed in the fourth quarter. Expectations are for weak growth, around 1.4% headline, depressed by the government shutdown. If GDP comes in as expected, the narrative will be that weakness was temporary. If GDP comes in even weaker, concerns about stagflation will intensify. Growth slowing while inflation runs at 3% is the worst possible combination. It leaves the Fed unable to cut because inflation is too high and unable to raise because growth is too weak. Money market traders are currently pricing 59 basis points of Fed easing for the rest of 2026. That is more than 2 full rate cuts. Clifton at Commonwealth Bank expects June and July cuts. If the data this week supports that expectation, the dollar declines further. If the data contradicts it, positioning unwinds violently because 59 basis points of expected cuts is a massive embedded bet that will reverse if the data says cuts are not coming. Either way, the thin trading calm of this week ends, volume returns, real money resumes repositioning, and the price discovery that was suspended during the holiday resumes with force. Let me bring this down to what it means for your money, because the abstract concepts of narrative and reserve currency status become very concrete when they affect your purchasing power, your savings, and your financial security. If you hold savings in dollars, which most Americans do, a declining dollar means your purchasing power erodes even if your account balance stays the same. A 9% dollar decline, like we saw in 2025, means everything imported costs 9% more. Electronics, clothing, cars, food ingredients, anything that crosses a border becomes more expensive. Your salary does not adjust for dollar weakness. Your expenses do. If you hold investments denominated in dollars, A weaker dollar creates contradictory effects that are difficult to navigate. American companies with overseas revenue see those earnings increase when translated back to weaker dollars, which boosts stock prices temporarily. But foreign investors holding American stocks see their returns reduced in their home currency, which drives them to sell and reallocate to markets where currency tailwinds rather than headwinds apply. The net effect depends on which force dominates, and in a structural dollar decline, foreign selling eventually overwhelms domestic benefits. If you are planning major purchases, uncertainty about the dollar makes every decision harder. A car that costs $40,000 today might cost $42,000 next year if imported component costs rise with a weaker dollar. A house that seems affordable at current mortgage rates might become unaffordable if Fed policy mistakes force rates back up. The inability to plan, the constant uncertainty about what things will cost and what borrowing will cost, is itself a tax on your financial well-being. And if you are counting on retirement savings to maintain your standard of living for decades, the structural decline of the dollar is perhaps the most important variable you should be watching. A 60% gold rally is not a trade. It is a verdict by the world's most sophisticated investors that the dollar will not maintain its value. When pension funds and sovereign wealth funds are buying yen and selling dollars, they are not making a short-term bet. They are making a generational allocation decision. And if their assessment is correct, if the dollar continues declining for a decade or longer as Macquarie suggests is possible, the retirement you planned based on current dollar valuations will not be the retirement you experience. The narrative of U.S. exceptionalism held the dollar together for years. That narrative is cracking, not because of external attacks on America, because of choices made by American policymakers, tariff chaos that introduced permanent uncertainty, political pressure on the central bank that undermines its independence, fiscal deterioration that calls into question the sustainability of American debt, institutional degradation that makes foreign investors question whether American commitments can be trusted. The dollar is holding gains this week in thin holiday trading. That tells you nothing about where the dollar is going. What tells you where the dollar is going is the behavior of real money investors who are selling dollars and buying yen. The 60% gold rally that represents a massive vote of no confidence. The Goldman Sachs assessment that the dollar cannot make up lost ground. The Macquarie warning that reserve currency status cannot be maintained indefinitely. The Bank of America observation that fundamental drivers of dollar weakness have yet to play out. Every piece of evidence points in the same direction. The narrative is cracking. The repositioning has begun. And in 72 hours, the data releases that will either accelerate or temporarily pause that repositioning will hit markets where volume has returned, and positioning will adjust violently to whatever the numbers reveal. Subscribe to Market Acme right now because this week's Fed minutes and GDP data are not ordinary releases. They are inflection points that will determine whether the dollar stabilizes or accelerates its decline. And the decisions you make about your savings, your investments, and your financial positioning in response to those releases could determine whether you preserve your purchasing power or watch it erode alongside a currency whose exceptional status is no longer exceptional. I am Kenzo John. This is Market Acme, and I will keep showing you what real money is actually doing, not what the thin trading headlines claim is happening. Because in an environment where the world's reserve currency is being held together by a narrative rather than fundamentals, and where that narrative is visibly cracking, the only protection you have is seeing clearly while others see only the comfortable story they want to believe. The dollar is holding gains this week. That means almost nothing. What matters is what happens when the holidays end, when volume returns, and when the data forces markets to confront the reality that the narrative of U.S. exceptionalism is the only thing standing between the dollar and a decline that could last a decade. The question is not whether the narrative cracks. The question is whether you are positioned for when it does.